You want to know why most traders blow up their accounts? It's not because they can't read a chart. It's not because they don't understand support and resistance. It's because they have no respect for their capital. None whatsoever. I've made millions in the market. I've also lost millions. And let me tell you something that took me years and a fortune to learn. The difference between those two outcomes had very little to do with being right about market direction. It had everything to do with how I managed my money when I was right, and more importantly, how I protected it when I was wrong. Most people think trading is about finding the perfect setup, the perfect indicator, the perfect entry point. They spend all their time looking for the holy grail of trading strategies. But here's what they don't understand. The market doesn't care about your perfect setup. The market will do what it wants, when it wants. And if you don't have rules in place to protect your capital, you'll be wiped out before you ever get the chance to be right. I learned this lesson the hard way. Multiple times. And each time I lost everything. It wasn't because I suddenly forgot how to trade. It was because I broke my own rules about capital management. I got greedy. I got emotional. I thought I was smarter than the market. And every single time, the market taught me the same painful lesson. Survive first, profit second. Today I'm going to share 3 rules of capital management that, if you follow them religiously, will keep you in the game long enough to actually make money. These aren't sexy. They won't make you rich overnight, but they will prevent you from joining the 90% of traders who blow up their accounts within the first year. Rule number 1. Never risk more than 10% of your total capital on any single position. This is the cardinal rule, the foundation. Break this rule and nothing else matters because you won't have any capital left to manage. When I was younger, I thought I had a system that couldn't lose. I'd studied the market. I'd seen the patterns. I knew I was right. So what did I do? I put everything into one position. Not 10%, not 20%, everything. And you know what happened? I was right about the direction, dead right. But the market moved against me first, just for a few days, and I got stopped out at a loss before the big move happened without me. That's when I learned something crucial. Being right about the market means nothing if you don't survive long enough to profit from being right. The market will test you. It will shake you out. It will move against you before it moves with you. And if you've bet your entire stake on one hand, you're done. Game over. 10% maximum per position. That means if you have $10,000, you never risk more than $1,000 on any single trade. If you have $100,000, you never risk more than $10,000. This isn't about limiting your upside. This is about ensuring that one bad trade, one unexpected news event, one gap down at the opening bell doesn't destroy you. I've seen brilliant traders, men who understood the market better than anyone I knew, completely wiped out because they violated this rule. They'd be right 9 times out of 10, but that one time they were wrong, they had their entire account on the line. And that was it. Years of work, gone in a single session. The mathematics are simple. If you lose 10% of your capital, you need to make 11% just to get back to even. Lose 20%, you need to make 25% back. Lose 50%, you need to double your money just to break even. See how the hole gets deeper? Every time you take a massive loss, you make it exponentially harder to recover. But here's the beautiful part of this rule. If you never risk more than 10% per position, you can be wrong 10 times in a row and still have capital to trade with. You'll be hurt, yes. You'll be down significantly. But you'll still be in the game. And as long as you're in the game, you have a chance to recover, get knocked out, and you have no chance at all. Now, some of you are thinking, but if I only risk 10% per trade, I'll never make real money. Wrong. Dead wrong. You make real money by being right consistently over time, not by betting the farm on one trade. The traders who last, who actually build wealth from the market, are the ones who understand that capital preservation comes first. Always. I knew a man once who turned $5,000 into $50,000 in 6 months. Everyone thought he was a genius. He thought he was a genius. Then he put $40,000 into one position because he knew it was going up. It went down instead. He was broke within a week. 7 months of work. destroyed by one act of arrogance. Don't be that trader. 10% maximum. No exceptions. I don't care how certain you are. I don't care if your mother's cousin's friend works at the company and says big news is coming. I don't care if every indicator you have is screaming at you to go all in. 10%. That's the rule. That's what keeps you alive. Rule number 2. Always use a stop loss and respect it like your life depends on it because your trading life does. Here's a truth that most traders don't want to hear. You're going to be wrong. A lot. Even the best traders, the ones who make fortunes, are wrong 40, sometimes 50% of the time. The difference between them and the failures isn't that they're right more often. It's that they lose small when they're wrong, and they win big when they're right. How do you lose small? Stop losses. A stop loss is your emergency exit. It's your parachute. It's the thing that prevents a manageable loss from becoming a catastrophic one. And yet, I've watched trader after trader refuse to use them, or worse, use them but then move them when the market hits their stop, hoping the position will come back. Let me tell you something. Hope is not a trading strategy. Hope is what destroys accounts. When I enter a position, I know exactly where I'm getting out if I'm wrong. Not approximately, not roughly, exactly. I decide this before I enter the trade, not after. And once that stop loss is set, it's set in stone. The market hits my stop, I'm out. No questions asked, no second guessing, no waiting to see if it bounces back. Because here's what happens when you don't use stops. A small loss becomes a medium loss. You tell yourself it will come back. The medium loss becomes a large loss. You're sure it will come back. The large loss becomes a devastating loss. Now you're praying it will come back. And finally, the devastating loss wipes you out completely. It never came back. I've made this mistake. I once held a losing position for weeks, watching it go lower and lower, each day telling myself tomorrow would be the day it turned around. You know what that taught me? That my ego was more expensive than any stop loss would have ever been. I lost more holding that one bad position than I would have lost on 50 properly stopped out trades. The purpose of a stop loss isn't just to limit your loss on that particular trade. It's to protect your capital so you can trade another day. It's to prevent one bad decision from becoming a terminal mistake. It's to keep you rational and disciplined when every emotion in your body is screaming at you to hold on. And here's the key. Your stop loss should be determined by the market structure, not by how much money you're willing to lose. You don't say, I'll risk $500 on this trade and put your stop wherever that amount lands. You look at the chart, you identify where the trade idea is proven wrong, and that's where your stop goes. If the distance to that point means you can only take 100 shares instead of 1,000, then you take 100 shares. Position size adjusts to your stop loss. Your stop loss never adjusts to your desired position size. I learned to think about stops this way. They're not losses. They're the cost of doing business. They're tuition paid to the market for the lesson that this particular trade didn't work. And just like any business, you have expenses. The successful businesses are the ones where the revenue far exceeds the expenses. In trading, your winners need to be bigger than your losers. But you can't control your winners until you control your losers. And you control your losers with stops. There's another benefit to stops that most people don't think about. Mental capital. Every position you hold takes up space in your mind. When you're holding a losing position without a stop, hoping it comes back, that trade consumes your thoughts. It's there when you wake up. It's there when you're trying to focus on other opportunities. It drains your energy and clouds your judgment on every other decision you make. Cut the loss with a stop, and suddenly your mind is clear again. You're free to focus on the next opportunity with fresh eyes and a clear head. This alone is worth the price of any stopped-out trade. Some traders tell me they don't use stops because they've been stopped out right before a big move too many times. You know what I tell them? That's going to happen. Accept it. It's part of the game. Being stopped out at a small loss is not a failure. It's the system working exactly as it should. What is a failure is holding through a massive loss because you refuse to accept you were wrong. You want to know the real secret? The trades where you get stopped out at a small loss and then watch the stock move in your direction without you, those sting, sure, but they don't destroy you. They're mosquito bites. The trades where you refuse to take a stop and watch a position collapse underneath you, those are fatal wounds. I'd rather be wrong and take 20 small stop losses in a row than be wrong once without a stop and lose everything, because I can recover from 20 small losses. I can't recover from being broke. So here's the rule. Every single trade you enter, you have a stop. You decide where it goes before you enter. And when it hits, you exit. No exceptions. No do-overs. No hoping. The market has told you you're wrong. Listen to it. The market is always right. Rule number 3, never add to a losing position. This is the rule I broke more than any other. And every single time I broke it, I regretted it. Every single time. Here's how it happens. You buy a stock at $50. It drops to $45. Now it's cheaper, right? It's an even better value than when you bought it at $50, so you buy more. Then it drops to $40, even better value. You buy more still. Then it goes to $35. And now you're not buying more because you think it's a good value. You're buying more because you need it to come back to $40 just to break even on your entire position. You've turned a trade into a prayer. This is called averaging down. And it's one of the most dangerous things a trader can do. The logic seems sound. If you liked it at 50, you should love it at 40. But here's the flaw in that logic. The market is telling you that you were wrong at 50. When you add to the position at 40, you're not buying a bargain. You're compounding a mistake. I once held a stock that I was certain was going higher. I bought in, and it immediately went against me. So I bought more. Then more. Then more. I kept averaging down, sure that any moment it would turn. You know what happened? It kept going down. And by the time I finally capitulated and sold, my average price was so far underwater that I'd turned what should have been a small, manageable loss into one of the biggest losses of my career. That's when I made myself a rule. I only add to winning positions, never to losers. Think about what this means. If I buy a stock and it goes up, and I still believe it has more room to run, I might add to the position. I'm adding to strength. I'm adding to something that's proven me right. The market is confirming my analysis, and I'm increasing my bet. But if I buy a stock and it goes down, the market is telling me I'm wrong. Why would I want to be more wrong? Why would I throw good money after bad? The answer is ego, pride, the inability to admit you made a mistake. Traders add to losing positions because they can't accept that their analysis was wrong. They're so invested in being right that they're willing to risk more and more capital to prove it. And the market doesn't care about your ego. It doesn't care about your need to be right. It will take every dollar you give it. Here's another way to think about it. Imagine you're playing poker. You bet big on a hand, and the flop comes out bad for you. Do you double your bet, triple it? Of course not. You fold. You save your chips for a better hand. But in trading, people do the equivalent of doubling down on a bad hand all the time. They call it averaging down and pretend it's a sophisticated strategy. It's not sophisticated. It's desperate. Now, I'm not talking about long-term investing here. If you're building a position in a company over time for your retirement account, that's different. But for trading, for active position management, adding to losers is a death sentence. I learned to think about it this way. Every position I hold should be profitable or near profitable. If I look at my portfolio and I see a position that's down 10%, 15%, 20%, that's a position that shouldn't exist. It should have been stopped out long ago. And the last thing I should be doing is making it bigger. The mathematics back this up too. Say you buy 100 shares at $50, $5,000 position, it drops to 40. You buy another 100 shares. Now you have 200 shares at an average price of 45. You've invested $9,000 total. For you to break even, the stock needs to get back to 45. But here's the problem. You've now doubled your risk. If the stock continues down to 30, you're down $3,000 on your original position, plus $2,000 on your added position. That's $5,000 in losses on a trade that should have been stopped at a $500 or $1,000 loss. See how the hole gets deeper? The successful traders I've known, the ones who lasted decades in this business, They all shared this trait. They were quick to cut losers and patient with winners. The failures did the opposite. They held their losers, hoping they'd come back, and they cut their winners too early, afraid of giving back profits. When you add to a losing position, you're doing two destructive things at once. First, you're compounding a losing bet. Second, you're taking capital that could be deployed in a better opportunity and throwing it into a position that's already proven problematic. I can't tell you how many times I've seen traders have their entire account tied up in one or two losing positions that they keep averaging down on, while incredible opportunities pass them by because they have no buying power left. They're so committed to these losers that they can't participate in the next big move. They're paralyzed by their own mistakes. Here's what I do instead. If I'm wrong and the position hits my stop, I'm out. I take the loss. And then I watch the stock. If my analysis was correct, and it was just bad timing, the stock will eventually tell me. It will show me that it's ready to move in the direction I originally thought. And when it does, when it gives me a proper entry signal from a better price, I can enter again. But this time, I'm entering a position that's working from the start, not one that's been dragging me down from the moment I bought it. This way, I'm only in positions that are working. I'm not married to any single trade. I'm not committed to being right about this particular entry at this particular price. I'm committed to making money, and making money means being in winning trades, not nursing losing ones back to health. The psychological benefit of this rule is enormous. When all your positions are at or near break-even or better, you trade with confidence. You think clearly. You're not stressed about the losses piling up. You're not hoping and praying. You're executing a plan. Compare that to the trader who's holding three positions that are down 20, 30, 40% each. Every morning they wake up in fear. They're checking their phone constantly. They can't focus on finding new opportunities because they're obsessed with these losers. They've turned trading into torture. I've been both traders. I know which one makes money and which one goes broke. The trader who cuts losses quickly and never adds to losers sleeps well at night and has capital available for real opportunities. The trader who averages down and holds on to losers is always stressed, always underwater, always one bad day away from being wiped out. So here's the rule. If you want to add to a position, it should be showing you a profit first. It should be proving you right. You add to strength, never to weakness. You pyramid into winning trades. You don't dollar cost average into losing ones. And if a trade isn't working, if it hits your stop or keeps bleeding slowly against you, you get out. You take the loss. You preserve your capital. And you wait for the next good setup where you can enter fresh with no baggage, no emotional attachment, and no hole to dig yourself out of. These three rules, they're simple. Risk no more than 10% per position. Always use stops and respect them. Never add to losing positions. Simple, but not easy. Because following them requires discipline. It requires accepting losses. It requires putting your ego aside and letting the market tell you when you're wrong. Most traders can't do this. They know these rules. They've heard them before. But they can't follow them because they're not willing to accept the pain of small losses. They'd rather hope and pray and average down and blow up their account than admit they were wrong and take a small hit to their capital and their pride. But the traders who make it, who actually build lasting wealth from the markets, they understand something fundamental. Your capital is your ammunition. Waste it on bad positions, and you have nothing left when the real opportunities appear. Protect it, manage it carefully, respect it, and you'll be around long enough to catch those big moves that make careers. I've made and lost fortunes multiple times, and I can tell you with absolute certainty, every time I followed these rules, I made money or at least preserved capital during difficult markets. Every time I broke these rules, I paid for it dearly. The market doesn't care about your potential. It doesn't care about your intelligence. It doesn't care about how many books you've read or how sophisticated your analysis is. The market cares about one thing. Are you managing your risk properly? Because if you're not, it doesn't matter how smart you are. You'll be gone soon enough. These rules won't make you rich overnight. They won't help you pick the perfect stock. They won't tell you when to buy or sell. What they will do is keep you in the game. They'll protect you from yourself. They'll ensure that when you are right, you have enough capital to profit from it, and they'll prevent your inevitable mistakes from becoming catastrophic. The market will always be here. The opportunities will always come around again. But if you blow up your account, you're done. You're watching from the sidelines while others profit. And all because you couldn't follow 3 simple rules. So make this commitment to yourself right now. 10% maximum per position, stops on every trade that you actually respect, and never add to a loser. Write these rules down. Put them where you can see them every time you trade. And then follow them. No matter what. No matter how certain you feel. No matter how good the opportunity looks. Your future self, the one who's still trading years from now with a profitable account, will thank you for it.